In this module, we're going to explore the equity method for accounting for equity investments. And remember, the equity method is invoked when we have a significant amount of ownership, but not quite ownership that would lead to consolidation. Of course, this is rounded because even 50.1% would give us the controlling votes in a company and give us consolidating uh, effects for our accounting. But when we are between 20 and 51% ownership, we do have substantial power. We can influence the policies of the firm, and therefore we want to take a little bit of a different view in terms of the accounting. We're going to start thinking about the investment more so from an ownership perspective. That is, rather than thinking about the price fluctuations embedded in a market valuation, we're going to look at the net assets of the corporation. So we're going to really focus on A minus L. What is left over after our obligations? This is kind of referring to it as a net asset investment. And you might see that if you get further into investment accounting and other sorts of advanced accounting, right? So how we're going to do this, we're going to purchase it. It's actually pretty simple in a very simplified case. So we'll start with the simplified case, and then we'll add some layers of complexity as we go through the journal entries. When we actually invest in the company, we just have the money paid for the whatever proportional ownership, 30%, 40%. That's what I mean by the proportional ownership. And so we're going to value the investment at historical cost whenever we make the initial investment. So that's pretty simple. Whatever amount we pay for it, whatever assets we trade for it, that establishes the initial value of an equity method investment. As the company, as our investment in our company, as that company begins to record profits over time, we then, as an owner, as someone who's invested in the net assets of the corporation, would recognize an increase to our asset. And that increase is triggered because any net income is going to be an increase in the net assets of the investment, which would increase our proportional ownership of those net assets. And so whenever there's net income reported by our investment, we would report a debit to the investment itself and a credit to investment revenue, right? So just another revenue account that shows our investment is increasing. The asset that we have recorded as our investment that we recorded at historical cost originally is increasing as we record revenue from that increase in the net assets of our investment. Dividends are a little different. Dividends, with the fair value method, we recorded cash and dividend revenue. In this case, because we are taking the ownership perspective, we are paying ourselves, but we're also an owner. And as we pay cash out, this is reducing the net assets of our investment. And so we debit cash, and then we'll credit the investment account itself. Why are we shrinking our investment? Well, remember, this represents an investment in net assets. As our invested company is paying us money, it's essentially reducing the net assets that we have control over. So it is a little bit of a different approach, but once you get those two things down, then it's not a big deal. And remember, of course, we're increasing investment revenue by the pro rata investment. So for example, if I invested in 30% of this company, I would get 30% of the total net income recorded as investment revenue. 30% of that net income increases my investment account. And then of course, 30% of the total dividends would be received in cash, and that would reduce my investment account by 30% of those dividends. We ignore changes in market value unless we opt the fair value option. That is something that a company can elect, and we'll talk more about that in the debt chapter. When a company elects fair value, they have to continue to report that asset in fair value. It's not a sort of one-off where they can decide, we're going to report fair value this quarter because things look good, but then we want to go back to equity method the next quarter. That's not quite how it works. However, most companies typically don't for these sorts of investments, for equity method investments. They won't elect the fair value option because that just brings in all sorts of volatility. Uh, Behind a significant number of shares, remember we're owning 20 to 50% of the shares of the corporation at this point. Well, any price fluctuations are going to have a pretty significant impact on the value of that investment. And if we elected the fair value option, those changes in value would go through net income, which isn't necessarily a good thing, uh, depending, right? So let's look at this example. I'm going to use this example and change it around a little bit. Like I said, we're going to start with the simplest case where Abel acquires 25% interest in the common stock of Cain. So we have a significant investment. They're purchasing a quarter of the company, and they're doing so with $2 million. Now, the next sentence is pretty key. So I'm going to try to draw some more attention to it by throwing it in red. The cost of Abel's investment equals the fair value and book value of the net assets acquired. So what that really means is I paid 25% of the book value of assets to obtain 25% ownership. And we're going to relax this restriction as we get more complicated. And we're going to talk about why would you pay more than 25% of book value? You might have some ideas already if you've really gotten into this accounting and you really think about, well, does book value approximate what I would pay for assets if I was buying them? Not always, right? And so in this case, however, we're going to say that they bought 25% ownership for exactly 25% of the book value of those assets and also 25% of the fair value of those assets. I think Cain reported net income of $4 million, distributed cash dividend totaling $1 million. And then I asked the first question just to kick it off, what is the total book value and fair value of Cain's net assets if $2 million buys 25% interest? And so again, I want you to be comfortable working with percents. It's not something that people tend to be very comfortable with. Sometimes we have a $2 million investment. Well, if we're trying to figure out, what total amount is 25%, that gives me $2 million. Well, then I'm going to divide the $2 million by 25%, and that'll give me that the book value of these assets must be, and their fair value of these net assets must be $8 million. So $8 million would represent 100% of the net assets of the investment. All right. So then let's put in a journal entry in order to record the acquisition of those equity shares, because remember, we are purchasing equity shares, just a significant number of them. When we do so, we're doing it at historical cost. We would just have an investment in Cain. It would just be a long-term investment. This, of course, is not going to be classified as trading or AFS because it is an equity method investment. The amount of cash we paid, we could pay with other items, but in this case, we paid with cash to kind of simplify it. And in terms of a cash flow statement effect, this would impact the cash flow from investing activities. It would drive it down by $2 million. And that's where we would find this cash flow. We would need to put it in investing activities, and we would want to show that it is a cash outflow from investing activities. When we record the income earned, we look at the $4 million that the investment earned, multiply that by our pro rata investment in the company, and that gives us the amount that we can record as an owner of this company. So we had a $1 million increase in the net assets of the investment. It increased overall by $4 million because that net income got closed out to retained earnings. Retained earnings affects equity, et cetera, et cetera. Those are my net assets. But since I own 25%, I only have $1 million of that. I would debit my investment in Cain. It would go up by that amount because now Cain has 4 million more assets in its corporation. That means I have control over 1 million of those since I own a quarter of them. And then we would record some investment revenue of $1 million. And remember, in terms of a statement of cash flows effect, obviously there's a net income effect here with the investment revenue. There's an increase in assets. We can label those effects pretty easily. However, in terms of a cash flow effect, this would hit net income. If I'm using an indirect statement of cash flows, remember to report the CFO, cash flow from operating activities, I'm starting at net income and then trying to pick it apart to derive cash flow from operating activities. This is an indirect method, CFO. Well, in this case, net income has $1 million, but I don't want that to be, there's no effect of cash. We're not trading cash around here. And so I don't want that to be in my cash. Therefore, I have to make an adjustment to my statement of cash flows. I have to adjust net income by $1 million down, subtract $1 million from my net income to obtain cash flow from operating activities. And again, you could have done it thoughtfully this way, or you could have just asked yourself, is there a net income effect? Is there a cash effect, right? Remember those items from Intermediate 1. Now we want to prepare for the dividend. The dividend was all in all $1 million. And so again, we are entitled to a quarter of that amount as a quarter owner in the net assets of the corporation. So that gives me $250,000 of cash that I receive. In this dividend, I receive the cash, recorded debit to cash for $250,000, increase my assets there. And remember, we don't record dividend revenue in this case because what we are doing with what is happening here is our investee is paying us some money. And as the investor, I am no longer controlling as many of the assets as the net assets in that corporation. So my investment in Kane is declining. And how this is recorded, again, dividends from an investee are recorded in either the CFO or the CFI. In this case, either way you go with it, you're going to have to show that cash flow. And the reason why that's a little different from the fair value method, where if we did it CFO, then we would have to, if we did CFO, we didn't have to do anything, was because there was a net income account involved. And when there was a net income account involved, net income already had the 250. Therefore, I didn't have to adjust it in any way to get CFO. In this case, there is no net income, so we have to show a cash inflow, even if we put it in CFO. On the other hand, with CFI, there's nothing to adjust out of net income because there is no net income account here. It's just two asset accounts. So think about that again. Compared to the fair value method, it's a good way to learn how there's the different mechanics whenever you're working with the indirect statement of cash flows. So for the income statement effects, we have investment revenue that we recorded. That does affect net income. It would technically be a non-operating activity for most companies in most industries. However, again, companies tend to play a little loose with that. So I wouldn't be surprised if it just gets bundled in with some operating investment revenue or something like that. But technically, it's non-operating for most. The account here for the balance sheet would be our investment in Kane. And if you are tracking that investment over time with a T account, it started at $2 million. We increased it by $1 million, and then we decreased it by $250. And so overall, we would have $2.75 million. And so that's the balance we'd find it at. Pretty straightforward so far, right? Like I said. So now we looked at the case where they would have some revenue. If there's a loss, we do the symmetric and opposite item where we would record an investment loss and a credit to our investment because if there is a loss and if our investee reports a loss, it's reducing their net assets. We control less of the net assets. Therefore, we should credit that investment account. So what happens then if we experience so many losses, we're just crediting this account over and over again, it could zero out. Well, if it zeroes out and we don't have any sort of underlying contractual obligation to help the investee, then we just could discontinue the equity method. If we do have an underlying contractual obligation, then the account would become a liability account because we still owe, and now the company is starting its net assets essentially. If this account zeroes out, if the investment zeroes out, that implies that we have negative A minus L, right? So now we have negative book value, and our investee has negative book value. And that means that we may owe, if there are underlying contractual support issues, we may have to help bail out our investee. If that's the case, then the investor has to record a liability rather than an investment account. If there is no underlying contractual obligation, if you're just sort of like a more typical limited liability shareholder, then you just zero it out and discontinue the equity method. Now, it may continue to experience losses, and you would have to track those over time, because if it starts to go into a gain position again, you would only start recording investment revenue once it zeroed out. So if it had climbed, for example, $175,000 on a pro rata basis in the hole, you would only start recording after you gained back $175,000 and it broke even again. If we sell the investment, then we're going to credit the investment account for whatever that balance is, debit whatever assets we're receiving in consideration, and then record a gain or loss on sale. Pretty typical from your normal sales here, things you've seen before with fixed assets and with more simple equity fair value method investments. We would just credit this for X, whatever zeroes out the investment account, and then we debit cash for Y. That would be the sale price or the consideration paid. And then whether or not this is balanced with a debit or credit. If we need a debit, of course, then we would have a loss. If we need a credit, we would have a gain. And both of these would be a gain on sale. Both of them would affect net income. So let me introduce a somewhat complex example of a sale. We're going to use the old example, except let's assume that Able didn't even make it to the end of the first year, right? It sold it instead. It purchased it on January 1st, 2017, and then decided to divest itself because a better opportunity came. They sold it on April 1st. They sold it to Ishmael for $2.15 million cash and equity shares. So this company, Ishmael, came over, gave us $2.15 million cash, and gave us some of their equity shares. Those equity shares were worth $1 million. On that date, they were trading at $50. They gave us 20,000 shares, and that was a 15% interest in Ishmael, which means that we don't have to worry about equity method in Ishmael. In this case, we would be a fair value method investor. So we use fair value accounting for them. So when we sell in the middle of a year like this, we're going to have to, as always, record any amount of or any accrual of net assets that occurred during the year. And so I tell you that we'll assume up to April 1st, Kane, the investment we're selling, had net income of $1.25 million, paid dividends of $100,000 up to that day of sale. So let's record their sale. Well, first thing first, we have to record what effect this had on our investment so we know how to zero out that account. So the $1.25 million Remember, we owed 25% of Cain. So we would get 25% of that increase, which would be 312,500. We would record that as a debit to the investment. And I'm just going to shorthand it rather than writing in Cain every time, just to save some time. And then we have investment revenue that we could record up to that date because we would accrue it, we earned it, we held that investment for that time. Now, they pay a dividend of 100,000. 25% of 100,000 is 25,000. That we received $25,000 of cash, and that credited our investment because it decreased the net assets of the investment that we have control over up to that date. So then taking that amount, those amounts, I'm sorry, and still applying, the original purchase price of $2 million, we have our investment T account. We had the $2 million purchase price. Our investment increased by 312,000. It decreased by 25,000. And then so the balance of the investment at the day of sale would be 2,287,500. So that is the book value of the equity method investment at the day of sale. Now we can continue and then record the journal entry for the sell. We received cash of $2.15 million. And we also received equity investment assets. So we received shares of the company that we sold our investment to. So they paid us with some equity shares. So we have now an equity investment. And we record that in the fair value way because we only have 15%. We do not have a significant influence in Ishmael as a result of this. Then we have our investment, and then I will write it out this time just so you're clear, even though that's a horrible penmanship for that investment. We have investment in Cain, and it's going off of our books at $2,287,500. And then now we just need to seal it off with a debit or a credit showing a loss or a gain on sale. Then we need a credit in this case to balance it. So we would have a gain on sale for $862,500. And that, of course, would flow to net income. And we would have a cash flow effect. We would have a cash inflow. We'd have now, and be careful with this, right? Because we'd have a cash flow effect. We would have CFI would increase. We'd have a cash inflow of $2,150,000. Now, would we have a cash outflow from our equity investment? No, we wouldn't, because these equity shares weren't purchased with money. They were purchased by trading that investment out. And then we'd have a gain on sale, which we would have to reverse. In the CFO, we would have to reverse the gain on sale, as we do all realized gains on sales, from net income to derive CFO. And again, notice the belabored way I do that. I don't just say, as I did here, it was a $2.15 million cash inflow to investing activities, because this doesn't really represent, I'm reversing it, I'm subtracting it. But this $862,000 does not represent a cash outflow. It just represents an adjustment so that I can correctly derive cash flow from operating activities under an indirect investment method. Right? So you might want to pause it there. Make sure you got all that, because now we're going to head into a more difficult case. Here, we have an existence of what we call a positive differential. And this is where we start to muddy the waters a bit, because this is typically what happens in practice. When you purchase a company, you are not likely to purchase the company as we did in the Cain and Abel situation, where 25% of the book value equals the amount that you pay for 25% of the ownership interest. Why? Because accounting goes accounting initially begins with very verifiable estimates, like the historical cost of buildings, for example. However, over time, the book value of that building no longer represents really its fair value. And so when we purchase something, we're always purchasing at fair value. We're not purchasing book value, right? The book value of assets does not approximate their fair value. We should know this by now by looking at fixed assets, the sell of fixed assets, the buy and sell of equity securities, debt investments. All of those things have a different book value than they had a fair value. Well, in this case, we're not probably going to see much difference. So a positive differential occurs when an investor pays more for the investment than the proportional share of underlying fair value of the net assets or book value. I say fair value, but it just has to be over book value for there to be a positive differential. And so, and then here I'll correct that as well, that the cost of the investment is greater than the proportional ownership, so 20%, 30%, whatever, times the book value of net assets or the fair value of net assets. So a lot of this, like I said, will be attributable to assets that just have a greater market value, fair value than book value. And some will be attributable to goodwill. And so we have to break that apart. Looking at a revamped example of this, I say that Castor purchased 25% of Pollux's outstanding common stock for $1.3 million when the underlying fair market value of the company's total net assets was $4.5 million. So start keeping track of these facts. I would recommend figuring out what the fair market value of net assets was. That's a key point. We have fair market value of net assets being 4.5 million. And it says the book value of the net assets was 4.1 million. A little bit of repetition in that wording. Then they say that the excess of the fair market value over the book value, so the excess of the fair market value over the book value, the spread here is 60% attributable to land, 40% attributable to fixed assets with an average useful life of 4 years. And so there's a $400,000 difference between these two. However, there's also, if we think about this in terms of the percent that we've purchased between the two, if we had purchased 25% of the fair market value of net assets, we would have paid $1,125,000. So that's the price for 25% of the fair value of net assets. And then if we had purchased the price of the book value of net assets, it would have been $1,025,000. So in order for this to have not had a differential, I would have paid $1,025,000. Any amount that I pay over that is a differential. Then we have to figure out, well, where did that price differential go? Because I ended up paying $1,300,000, which is above the 25% of the fair market value of the net assets, which was $1,125,000, which was above $1,025,000, which was 25% of the book value. Right? I do explain the difference between these two guys. I say that 60% of that was attributable to land. So we had some land that had a greater fair market value than book value. And then we had 40% of that be fixed assets that had a greater book value than fair value. And then if you recall, if you reach back and think, wait a minute, I might remember that if I pay in a purchase, if I pay more than the fair value of net assets, I have to record something. What is it? Think about it for a second. Maybe you can come up with it. If not, I'll give you the answer. This is goodwill. Remember, goodwill is any price paid over the fair value of the net assets of something you're acquiring. And in an equity method, we could have some of this be attributable to Goodwill. Now, we're not going to record it. We only record Goodwill when we're actually consolidating, when we're actually acquiring a majority interest in the company. But in this case, it's still informative in terms of where these items are going, and you'll see why in a second. If the excess is attributable to assets that have greater fair values than book values, then we have to add another adjustment. We have to amortize the difference of this over the life of the assets. So for example, with those fixed assets, our investee is going to be depreciating them over 4 years. Well, that's going to reduce our net assets. It's going by reducing net income. So we'll record a little less of an increase in our investment because of that depreciation effect. But because we're paying a price over and above that amount, we have to apply, if you will, a little extra depreciation. We'll talk more about this in tuition in class because I think people get stuck on it, and I want you to be able to nail that down. Now, if we don't allocate the cost of the asset over its useful life, i.e. land and goodwill, then we don't have to worry about it because the investee is not amortizing it. Therefore, any price we paid for it is not going to be amortized in excess. So only when the investee is recognizing some sort of a cost allocation, be it on intangible assets or fixed assets, then we have to amortize a little extra because we paid more than the book value that the investee is amortizing or depreciating. When they don't, we don't have to worry about it. There can be a negative differential. We might pay less than what the proportionate ownership would suggest. So maybe we pay, we actually pay only 20% for 23% ownership in a company. Then we would have a negative differential. Either way, we get some back, and we need to amortize those things as long as they are due to something that the investee is adjusting over time. So let's continue with that example that we saw initially, right? That I said Castor purchased 25% for $1.3 million when the underlying fair market value was 4.5 and the book value was 4.1. How do we record that? Well, nothing much changes in terms of our normal, I'll say our vanilla entries. Our investment in Kane is still at historical cost. So in this case, we purchased it at $1.3 million. We would still record 25% of the net income that was produced by our investee, in this case, $490,000. So $490,000 times 25% gives me $122,500 of an increase in my investment in Kane. And that's still investment revenue because it increased my ownership of net assets. It still hits net income. Now they declared dividends on 400,000 outstanding shares for $1.20 per share. So if there's 400,000 outstanding shares, we own 25% of the company. Then that means that we own 100,000 shares. 100,000 shares times $1.20 per share gives me $120,000 of cash. And again, that decreases my investment in Kane by $120,000 because it's reducing the net assets over which I have control. Now for the final entry, again, I just want to kind of draw out that excess just to make it crystal clear where it's coming from. We paid $1.3 million. That was the purchase price. The excess of the purchase price over the fair value, and I'm going on a pro rata basis, so the fair value of 25% of those assets, that means that I have $175,000 of goodwill. I don't have to record it, because it's equity method. However, I'm just showing you that that's where that gets allocated. Now, the next rung was the book value, 25% of the book value of net assets. And then I said that this difference, which is 100,000 on a pro rata basis, goes 60% to land. So that means that I have a $60,000 overpayment to do to land, which doesn't get allocated, so I can ignore it. And then I have 40% of this going to those fixed assets with a useful life of 4 years. Well, so I paid $40,000 proportionally more for these fixed assets than they're listed at on the book value of my investee. As my investee depreciates these assets, they're going to reduce their net income by the depreciation, but they're only going to do it by the book value, not by the fair value that I paid. So I have to take a little more off the top, in this case 40,000 divided by 4, because I'm splitting that excess up over the useful life of those assets just as my investee is. I'm matching that expense appropriately, and I'll just call it amortization. It does affect net income. It reduces my net income, and it reduces my investment in my equity method investee. Okay. And this would have a cash flow effect because this is a non-cash expense, right? It's reducing an equity account. But when I ask myself those two questions, does it affect net income? Yes, it does. It drives down net income by 10,000. Does it affect cash? No, it doesn't. Well, then if I want net income to become cash, I would have to add $10,000 back to net income to derive cash flow. So I'll stop there. It's a lot to swallow and digest. Make sure that you understand the why of all of this so that you're not just completely lost. And this is a lot of where you'll pick up in advanced accounting with equity method investments, with advanced consolidations, with allocating the excess of purchase prices and such. So that's just a little taste for you guys. You would get a lot more in advanced accounting. Thank you very much for watching, and we'll pick up in the next video with some advanced topics that include what happens when we shift classifications of investments, how to record that with journal entries, and how IFRS is a little different with investments. And then the final segment will be about impairment of our investments. I know you were waiting for an impairment because you loved it so much.